Namibia's central bank has left its main lending rate unchanged at 5.5% for the fifth straight meeting as it tries to boost economic growth. For more, we are joined by Governor Ipumbu Shimi from the Bank of Namibia. Governor, thank you so much for making the time to join us. Perhaps you could talk us through the decisions that inform the decision to leave the lending rate unchanged.
Thank you very much for having me. The decision, as usual, was based on the review of both global and domestic economic conditions. At the global level, we have seen the recovery is still continuing, although gradual, especially in the US economy and also in the UK. We have also seen that emerging markets are still leading the growth in the global economy, particularly China and India. But the external demand or external conditions still remain weak for our exports. As you know, that most of the goods that we sell outside are commodities, and commodity prices have actually been declining for the past 10 months or so of 2013, although they have now stabilized at the level where they are compared to where they were in 2012. They have actually come down significantly. And as a commodity exporting country, that weak demand is still there because of the slowed growth or weak growth in advanced countries, as well as still reasonable growth in emerging countries, but of course compared to where they were 5 years ago, is still slower. So on the basis of that, we have decided to keep the domestic interest rate the same at 5.5% to support economic activities. What we also looked at is the numbers for the GDP figures for 2013, which we are about to conclude, as well as forecast for 2014. Because of the weak external environment, we have revised our forecast for 2013 from where they were at 4.7. At the beginning of the year, we thought that the economy was going to grow by 4.7%, but we have now revised that downwards to around 4% because of the weak external demand. On the inflationary front, it's actually good news in the sense that inflation has come down and has remained stable for the past few months. And we also believe that going forward, inflation is going to stay within reasonable ranges. What is worrying to us is a continued increase in credit going to the private sector, especially installment credit. That is something that we are monitoring, and we believe is something that may warrant some action going forward. So based on all those developments, we have actually decided to keep interest rates at the same level.
Governor, that's a very comprehensive response. Perhaps if I could take you a step back and let's touch base again on the pressure on exports in terms of us seeing weak demand right now. We're also seeing international reserves falling because of this weak demand. How worrisome is this trend at this time?
Yes, international reserves have also been falling, largely because, yes, you're right, because of the weak demand, but also and mainly because of the huge import bill. Namibia is currently in a phase where we have significant expansion in the mining sector. 2 mines under construction. In fact, a third one joined a few weeks ago. So we actually have three mines that are under construction. As a result, we have a significant need for imports of machineries, and as a result, our import bill has actually gone up significantly. In addition to that, we have also seen some financial flows, money flowing, especially to our neighboring country for investment purposes. That has contributed to to the decline in reserves. Although with reserves at the current level, we still feel that they're adequate. Because of those two developments, reserves have come down as compared to the previous months. We believe this is, especially the huge import bill, we believe this is a temporary problem because, you know, the construction of mines, once these mines are up and running, they will be able to generate exports that will generate reserves. But you know that some of these mines will only come on stream in the next two to 3 years. For now, reserves will be under pressure, but we believe that they will still be sufficient to support our current exchange rate arrangement.